Welcome to Financial News Daily. Let me give you 3 numbers that I think tell the story of 2026 better than any headline has managed to so far. 22.9%, 53.9%, 5.2%. The first number is gold's 12-month return as of today. The second is silver's 12-month return over the same period. The third is the yield on the 30-year United States Treasury bond, the highest it has been since 2007, a 19-year high reached just this morning. Most financial coverage will tell you one of 2 stories about these numbers. Either they signal continued strength in precious metals and you should buy more, or they signal dangerous overvaluation in a rising rate environment and you should sell. Both stories are too simple. And both of them miss what these numbers are actually telling you when you look at them together, in sequence, against the backdrop of everything that has happened this year. Let me try to tell you the real story. Start with where we were on January 1st. At the start of this year, gold was trading near $3,250 per ounce. Silver was near $40. The 30-year Treasury yield was around 4.5%. The Federal Reserve had signaled 2 to 3 rate cuts for the year. Inflation was declining. The consensus view among every major investment bank was that we were entering a period of gradual normalization, lower rates, contained inflation, moderate growth. Goldman Sachs had a year-end gold target of $5,400. J.P. Morgan called for oil at $85. The International Monetary Fund projected global growth of 3.2%. These were not reckless projections. They were the careful, data-driven conclusions of institutions that employ thousands of analysts and have access to every piece of publicly available economic data. Every single one of those projections has been overtaken by events. Now let me take you through the 6 months that followed, because the sequence matters as much as the endpoints. February 28th. The US-Iran conflict begins. Oil starts rising immediately. The Strait of Hormuz, which carries 25% of the world's seaborne oil, becomes a contested waterway overnight. March through April. Gold surges from $3,250 to $5,589, a 67% gain in under 3 months. This is the fastest sustained gold rally since the 1980s. But here is what most coverage missed: the rally was not primarily driven by the war. It was driven by what the war did to inflation expectations, and what inflation expectations did to the market's view of the Federal Reserve. Gold is not a war asset. It is a monetary asset. It rises when confidence in paper money falls. And what the war did, almost immediately, was raise the probability that inflation would accelerate, which raised the probability that the Fed would face a credibility test, which raised the probability that the tools available to restore price stability were insufficient for the problem at hand. That scenario, a central bank unable to bring inflation back to target, is the scenario where gold performs best in modern history. May through June. The rate hike narrative takes hold. With oil above $90 and inflation running at 4.2%, the market begins pricing in not rate cuts but rate hikes. The Federal Reserve holds rates steady in June, but the language shifts. 3 members of the committee dissent in favor of immediate action. September hike probability moves from near zero in January to 60% by end of June. Gold falls from $5,500 to $4,000. A 27% correction. The media declares gold's rally over. Investors who bought at the peak are sitting on significant paper losses. July. Gold falls further, to $3,975, the 9-month low reached in mid-July, the lowest since October of last year. Then the Federal Reserve holds again on July 29th. 3 members dissent. Gold rebounds to $4,100. The 30-year yield hits 5.2% immediately after the decision. And that is where we are right now. Now here is what the full 6-month sequence tells you, if you read it as data rather than as a series of isolated events. The first thing it tells you is that the structural demand for gold has proven more resilient than the rate hike headwind gave it credit for. Gold fell from 5,500 to 3,975, a significant correction. But it is still up nearly 30% from where it started the year at 3,250. In a year where long-duration bonds lost 15 to 22%, where equity indices fell 8 to 12%, and where the Fed is considering further tightening, gold's 12-month return of 22.9% represents one of the most significant outperformances in modern financial history. The second thing the data tells you is that silver's 53.9% 12-month return is carrying a different message than gold's 22.9%. Silver is both a monetary metal and an industrial one. Its 12-month outperformance of gold tells you that at least some of the precious metals rally is being driven by industrial demand, specifically demand from the solar panel and electric vehicle supply chains, which require significant quantities of silver. That industrial component is less correlated to Federal Reserve policy than the monetary component. It responds to manufacturing activity, to energy transition investment, to the structural shift in global energy infrastructure that is occurring alongside and partly because of the conflict. When silver significantly outperforms gold, it often signals that the broader commodity cycle has more momentum than the rate hike narrative suggests. Not always, but often enough to be worth examining. The third thing the data tells you, and this is the one I want to spend the most time on, is what the 30-year Treasury yield hitting 5.2% means for everything else. The 30-year yield is the longest price signal in the U.S. financial system. It tells you what the bond market thinks the average level of interest rates will be over the next 30 years. Not next month. Not next year. 30 years. And at 5.2%, up from under 2% as recently as early 2022, it is sending a message that the era of cheap money that defined the financial landscape from 2008 to 2022 is not coming back anytime soon. This matters for every financial decision you make, regardless of whether you own gold or bonds or equities or real estate or simply keep money in a savings account. For real estate, it means that the affordability crisis in housing is not a temporary phenomenon. Mortgage rates above 7% are not an aberration to be waited out. They are the market's current pricing of long-term financing costs in a world where the 30-year yield is 5.2%. If that yield stays elevated, and a 19-year high following a Fed hold with 3 descents suggests it might, the expectation that mortgage rates will return to 3 or 4% is not a near-term prediction. It is a fantasy. For equities, the 5.2% 30-year yield creates a gravitational pull on valuations. Every company that generates cash flows in the future has those cash flows discounted at some rate. When that discount rate rises, which is exactly what happens when the 30-year yield rises, the present value of future cash flows falls. This is the mechanism that has caused technology and growth stocks to underperform in high-rate environments throughout history. It is not a secret or a complicated insight. It is arithmetic. And the arithmetic currently favors cash-generative businesses with near-term earnings over high-growth businesses with earnings expected far in the future. For bonds, the 5.2% 30-year yield creates the most uncomfortable dynamic for existing long-term bond holders, and potentially the most attractive entry point for new ones. If you hold a 30-year bond purchased when yields were 3%, your bond has lost a significant portion of its market value. But if you are considering buying a 30-year bond today at 5.2%, you are locking in a yield that was not available at any point in the past 19 years. Whether that is attractive depends entirely on your view of where inflation and rates go from here. Bill Gross, the former PIMCO chief who spent decades as the world's most influential bond investor, has written that the critical question for long-duration bonds at these yield levels is not whether they offer an attractive absolute return. At 5.2% on a 30-year Treasury, the absolute return is better than it has been in nearly 2 decades. The question is whether that return adequately compensates for the inflation risk over 30 years. And at 4.2% inflation and a Fed that is still holding rather than decisively tightening, he argues the answer is genuinely uncertain. For gold, the 30-year yield at 5.2% means the opportunity cost of holding gold is higher than it has been at any point since 2007. Gold earns nothing. A 30-year Treasury earns 5.2% annually, backed by the full faith and credit of the United States government. Every percentage point of yield that Treasuries offer is a percentage point of return that gold cannot match. This is the single largest headwind to gold prices in the current environment. And yet gold is still up 22.9% over 12 months. Which tells you something important about the strength of the structural forces supporting gold even in the face of this headwind. And about what happens to those structural forces when the headwind eventually eases. Because the 30-year yield will not stay at 5.2% forever. The Federal Reserve's rate hiking cycle, whenever it concludes, will eventually reduce the short-term rate pressure on the economy. Inflation will eventually moderate either because the Strait of Hormuz situation resolves, or because demand destruction from high energy prices does the Fed's work for it, or because both. And when the rate pressure eases, the relationship between the headwind and the structural case for gold reverses. Commerzbank, which just lowered its year-end gold forecast to $4,500, is effectively saying it believes the headwind remains dominant through December. Goldman Sachs, maintaining its 5,400 target, is saying the structural case will reassert itself before the year is over. Both of those positions could be right at different points in time. The question of which is right in December depends on variables that do not yet exist, specifically, whether September brings a rate hike, and whether that hike begins the process of bringing inflation sustainably back to target, or whether it proves insufficient and the environment remains as uncertain in December as it is today. What the 6 months of data tells you most clearly is this: the year that arrives is rarely the year that was predicted. The people who navigated the first half of 2026 best were not the people who correctly predicted the war or the inflation spike or the rate hike debates. They were the people who held positions resilient enough to survive being wrong about those predictions while still participating when things moved in their favor. The second half of this year will offer the same test. Something will happen that no one is fully predicting. Some asset will outperform expectations and some will disappoint. The people who look back at December with the least regret will not be the ones who made the most confident bet on the outcome they most believed in. They will be the ones who stayed honest about what they did not know, and built their position around that honesty. Everything here is for informational purposes only. This is not financial advice. Please consult a qualified financial advisor before making any investment decisions. One question for you: which of the three numbers I started with, gold's 22.9%, silver's 53.9%, or the 30-year yield at 5.2%, surprises you most? Tell me in the comments. We do this every week. Stay informed. Stay ahead. Financial News Daily.